Let's talk about the March contract. Now, I haven't updated it over the last 2 days, but a couple of days ago, there was still 47,847 contracts in silver outstanding, with 4 days left till it comes off the board. That's 239.2 million ounces of silver. In contrast, the total registered silver inventory, that is the category of metal specifically earmarked for physical delivery, stands at 88 million ounces. What this is a paper Ponzi scheme, and it's a looming game of musical chairs. If even half of that open interest actually decided to stand for delivery, that's 120 million ounces with only 88 million ounces in registered. Do you see how that becomes a massive, massive problem?
The silver market is fracturing deeply, and a massive crater is forming deep beneath the surface. According to renowned bullion dealer Andy Schectman, what we are witnessing is a full-scale delivery crisis unfolding simultaneously across COMEX, the LBMA, Shanghai, and even inside the major silver ETFs. Big money is no longer content to play the paper game. They are standing for delivery, and that single decision exposes everything. The January 30th Silver Slam? In Andy's view, it wasn't random volatility. It was deliberate, coordinated, and designed to shake out weak hands before something much bigger hits the system in March. Because when you strip away the headlines and look at the mechanics, the picture becomes explosive. February gold contracts sitting at 24 times normal open interest this late in the cycle. Silver vault withdrawals exceeding delivery demand by over 160%. Tens of millions of ounces quietly leaving the COMEX ecosystem. And a March silver contract representing nearly 3 times the amount of metal actually registered for delivery. This is no longer about daily price swings. This is about whether the exchanges can honor the paper promises they've written. Andy argues that confidence has always been the backbone of the Western pricing mechanism, but confidence disappears the moment the market suspects there isn't enough metal. And when leverage unwinds in a commodity market, moves don't drift higher, they erupt. He believes silver is not going to sit in the low 80 range much longer. If the delivery strain continues and exchanges fail to contain it, we're not just talking about revisiting prior highs. We're talking about new record territory as the paper mechanism loses control. In this video, Andy breaks down far more than just contract numbers. He walks through the shifting delivery dynamics between COMEX and the LBMA, the extraordinary vault withdrawals, and why Shanghai continues to trade at a persistent premium, drawing physical metal eastward at an accelerating pace. Stay with me through this breakdown, because the details matter. If you hold physical silver and understand the difference between paper price and real metal, this conversation is critical. Like the video, subscribe if you haven't already, and tell me in the comments, do you think March is the breaking point? We appreciate the support and hope you enjoy the video.
Well, I think we could start with, well, we'll talk about gold and silver. Everyone's focusing on the March contract. But with the February contract, which completely is gone in a couple of days, right? Like 3 days. As of yesterday, for February gold contract, right? There were still 4,366 contracts open. That's 436,600 ounces, or 13.5 tons of gold. Now, what's unusual about that, in fact, insanely unusual, is that it's insanely high, that number for this late in the cycle. In fact, it's 24 times normal. It's even bigger than the upcoming March contract, which I don't know if that's ever happened. That's a massive red flag. And really what it means, what most people would tell you it means, is a classic fingerprint of a big short that sold gold that they may not actually have to pay back. And if they were planning to buy it back, one would assume that they're somewhat trapped because liquidity is this late in the February contract is very thin. So normally when a contract goes off the board, like for example, the March contract goes off the board on Friday here, meaning it's time to either roll forward to probably the May contract, cash settle, or stand for delivery. And so when you see things this late into the February contract where there's that much gold that could stand for delivery that hasn't yet, it's very, 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 very unusual. And this is the kind of environment where, everything that the West has done for a long time is all about confidence. And for a long time, no one questioned the integrity or motivation of the West or of the United States. But that might be changing. And the moment the market believes that there isn't enough gold, the leverage that has really been the hallmark of this industry or of this platform unwinds. And when the leverage unwinds and commodities, moves become really violent. But I think it's also important to look at the more explosive brother or sister or cousin of gold, and that's silver. Let's start with the February contract again, because everyone's focusing on March, but I want to focus on the paper claims versus deliverable supply. It's important to understand that one COMEX contract equals 5,000 ounces of silver, right? We know that. And we've talked a lot about the deliveries. It's been really, as far as I'm concerned, all that people need to understand is that the biggest, most well-informed money in the world. In fact, since I met you, this is really what we've talked a lot about. I mean, we've talked about a lot of things, bricks and everything, but go back 5-6 years, we started talking about deliveries coming out of COMEX with the others, and it's been what we've focused on. Because the people that are standing for delivery in these quantities are well-informed, not just well-funded, very well-informed, and they know where the puck is going, like Wayne Gretzky used to say, I don't skate to the puck, I skate to where it's going. And when you're spending 9 figures buying metals, in this case, every month, question needs to be asked, and the only question needs to be asked, who the hell is doing it? And where's it going? Now, the where's it going part, some people will debate. Well, a lot of it stays in COMEX, Andy. They'll say, okay, some of it does. That's called the eligible category, where it could be sold if wanted to be sold, but it doesn't want to be sold. I've mentioned how we have 8 Brinks facilities throughout the country. One is in New York City. That is a Brinks facility. A COMEX facility. Of the 8 Brinks facilities we have in North America, one is COMEX. It's Brinks JFK. And I have lots of clients in there that, and you probably do too, that have 1,000-ounce bars inside of the eligible category. They're not for sale, and they're not backing the bars that are listed on the COMEX exchange right now, although they could be if they wanted to. Anyways, so we've seen in February 4,639 contracts delivered. That equals, what does that equal? 23,195,000 ounces of, this is silver, by the way, 23,195,000 ounces of silver. So 4,639 contracts times 5,000 ounces is 23,195,000 ounces. Okay, so that's about the low end of what we've seen since a year ago, November, every single month. Every single month, it's been between typically 30 and 70 million ounces that stand for delivery. So that's a big deal, right? But here's a bigger deal. So while we have seen 23,195,000 ounces stand for delivery, in the month of February, we have seen 38,082,934 ounces leave COMEX. Leave. Now, if I keep saying this to put it in perspective, if a mint box of Silver Eagles weighs 42 pounds for 500 ounces, who took possession of 38,082,934 ounces? How many semi-trucks is that? And where is it going? And so I would say to you, the people that are doing this understand where the puck is going. The people that are spending this kind of money and withdrawing it out of the ecosystem, where the vault withdrawals are 164% of the February delivery demand so far, that means more metal is being pulled out than delivery alone can explain. This is highly unusual, highly. Let's talk about the March contract. Now, I haven't updated it over the last 2 days, but a couple of days ago, there was still 47,847 contracts in silver outstanding, with 4 days left till it comes off the board. That's 239.2 million ounces of silver. In contrast, the total registered silver inventory, that is the category of metal specifically earmarked for physical delivery, stands at 88 million ounces. What this is a paper Ponzi scheme, and it's a looming game of musical chairs. If even half of that open interest actually decided to stand for delivery, that's 120 million ounces with only 88 million ounces in registered. Do you see how that becomes a massive, massive problem?
What stands out after Andy lays out the contract imbalance isn't just the math, it's the behavioral shift. The institutions withdrawing metal aren't reacting emotionally, they're repositioning structurally. Vault withdrawals exceeding delivery demand suggests something deeper than routine contract settlement. This is capital migrating out of a leveraged system into direct control, and once metal leaves the exchange ecosystem, it no longer cushions the paper structure that depends on confidence and rollover behavior. That's where the global dimension becomes impossible to ignore. The movement isn't random, it's directional. The East is absorbing supply, while Western exchanges continue pricing silver through leverage and margin manipulation. The persistent premium in Shanghai signals a real-time divergence between where silver is priced and where it is valued. And when physical demand remains strong despite engineered volatility, it suggests that price suppression tactics may be losing effectiveness at exactly the wrong time for the exchanges.
So I think when you talk about where the metal is moving, whether it be standing for delivery here or the continued arbitrage that we see in Shanghai, where the silver price has been between $10 and $20 an ounce more than in the West, enticing arbitrage. Normally, an opportunity like that doesn't last very long as the sophisticated traders capitalize on that arbitrage. But when you realize that it is staying strong, that tells you that the Chinese are saying, look, we're choking on dollars. The dollars are not worth as much as the silver. Keep the arbitrage, keep that higher premium so that you get the traders who will buy 20 million ounces in the West and deliver it in China. Typically, there's a COMEX contract that goes right to Hong Kong where a Brinks truck would pick it up or a truck would pick it up and bring it to Shanghai at a $20 or $15 or $20 an ounce premium on 20 million ounces. You're making enough to change your life 10 times over. And are they doing it? Sure. And it's not even that premium that they're paying, the Chinese are paying to buy that. On top of that premium, there's a VAT tax. That VAT tax is not the responsibility of the exporter into China. It is the responsibility of the recipient when it leaves the Shanghai Metals Exchange. They will be charged a VAT tax. So they're willing to pay a 13, 14, 15% VAT tax and a $13 or $14, $15 premium on top of that to entice the Western traders to send it. That tells you where the real value of silver is, and the movements and the mechanics and everything we've seen so far in terms of price to the downside in many respects is contrived through raising margin requirements, through trying to squeeze the speculators out. And you can see that by the open interest, which is falling considerably. It worked. It did. And that metal then has moved into the strong hands who don't use margin, who I would venture to say over the next several days plan on standing for delivery in huge amounts. And now that Shanghai is open today and you see the price down a little bit, it's interesting as we get right to the end of the delivery cycle. This is what they're going to do again, where we saw before the price got hammered. Not only did JP Morgan cover almost 800 contracts at the very, very, very bottom. Interesting how they did that. But how about SLV? During Silver Squeeze, SLV said BlackRock amended the prospectus, I think, on a Saturday night. And they said there's such inflow coming and there could be a lag between the time that we indeed confirm this as a good trade and when the shares are issued, because it's coming so fast and there could be a discrepancy there. Shares are issued when the metal is deposited into the exchange. So right before the market collapses, it's at $115, $120 an ounce, record volume into SLV. It collapses, and right at the bottom, guess what? 38 million ounces of silver are deposited into SLV by an authorized participant at the bottom where the shares are created. Does it seem interesting that they sell it up here, they deposit it down here, and then the metal moves from the COMEX into the SLV vaults that are institutionally controlled by those commercial banks that issue the shares, and they continually do what's called share redemption and stand for delivery on metal inside the SLV ecosystem and GLD with great privacy. It's far more difficult to tell who did that than it is to look at the COMEX COT reports or the delivery reports. So lots of stuff going on, but again, the movement of metal is, to your point, really all that needs to be seen, whether it be deliveries on COMEX, deliveries out of the COMEX ecosystem, or standing for delivery across the globe. And with people at this level are the most well-informed traders on the planet. That's all you need to know, and understand that price is the greatest tool of misdirection, and they will do all they can to shake people from the bushes. This is no different. The paper price still is in control until it's not, because we're getting to the point where paper suppression and manipulation that is naked, meaning you cannot come up with the metal to deliver, perhaps like we see happening here in February with this big gold short. Who knows where it ultimately goes? So I think to be on the wrong side of this trade in a naked position right now is as silly as a mud wall, and maybe that's what this was all about last time. One other point, I don't think you'll see this again. I think it was a Hail Mary, because I think it really disrupted much of the economy. When you look at what it did to the refiners and how the refiners have a far greater, they're not just providing liquidity to this industry. The refiners, these refiners in the U.S. have a big role in many industries, and this is something that had many corollary effects that were far removed from the COMEX leverage. And I think they probably got a lot of crap about this, whoever they are. I don't expect to see this kind of margin increase really cripple the industry from the top on down because of lack of liquidity. And, it certainly worked at getting the leverage out of COMEX, but it also had some profound effects on this industry, from the refiners to all the big companies. And even the companies who don't hedge are facing the issue of this kind of volatility that has been induced by raising margins, where you see these very unusual synthetically induced drops. So I think it was kind of a one-off maybe to get these banks in the United States who, according to the COT report and the Economic Times article, have been largely net long in silver and gold. But that doesn't mean long. That means you could have 12 long and 11 short. You're still net long by one. Maybe it was done specifically to get them far more on sides as we get more and more serious with the inventory problems at COMEX and LBMA.
The arbitrage opportunity Andy describes is not theoretical. When silver trades $10 to $20 higher in Shanghai, traders are incentivized to move massive quantities across borders. But the key point isn't the profit, it's what the premium represents. It reflects a market willing to pay significantly more for assured access to physical metal. Add in VAT costs on the receiving side, and the willingness to absorb those expenses signals something even stronger: a strategic priority on securing supply, not speculating on price. At the same time, margin increases and engineered sell-offs have successfully flushed out leveraged speculators. Open interest has fallen, weak hands have exited. But that metal hasn't disappeared. It has migrated into stronger hands. Investors who don't rely on margin, who intend to stand for delivery, and who appear increasingly indifferent to short-term volatility. That transition from speculative positioning to structural accumulation changes the risk profile of the entire exchange. Then there's the ETF dimension. The creation and redemption cycles inside vehicles like SLV and GLD introduce another layer of opacity. Metal can shift between vault categories and institutional channels with far less transparency than direct COMEX delivery reports. That matters because as inventory pressure builds at both COMEX and the LBMA, the margin for error shrinks. Paper pricing mechanisms function smoothly until too many participants simultaneously request the underlying asset. Andy's bottom line is clear: price is the greatest tool of misdirection. It can be hammered lower to create fear. It can be squeezed higher to induce speculation. But ultimately, the only metric that matters is movement of metal. And right now, metal is moving out of Western exchanges, toward higher premiums, into strong hands. If even a fraction of outstanding contracts convert into physical demand during this delivery cycle, the leverage unwind could be violent. The paper system remains in control until the moment it isn't. And if that moment arrives in March, silver may not just break higher, it may redefine what all-time high means in a market where physical supply finally overpowers paper promises. Do you believe March is the inflection point? Or do you think the paper system has one more trick left? Drop your view in the comments, especially if you're holding metal outside the system. Like this video if you value real delivery data over headline noise. And if you haven't subscribed yet, now is the time. Because if the delivery mechanism fractures, you won't hear it from mainstream finance first. You'll see it in the vault data, the premiums, and the contract expirations. And we'll be tracking every ounce of it. Thanks for watching.